My name is Richard. I'm with R.A. Copeland. We're commercial real estate financiers, advisors, and more. I cannot stress the advisors part during this time in the market when people are going into foreclosure and things of that nature. Definitely reach out to your mortgage broker, whoever that may be, and chat with them about your options if you find yourself in a sticky situation from that standpoint. A little bit about us. Capital intermediaries, doing debt and equity for commercial and multifamily real estate nationwide. Over 15 years in the business and been involved in over $4 billion in financing over that time. Uh, we pretty much cover every commercial real estate income producing asset type from that standpoint: apartments, self storage, office, industrial, pretty much any commercial income producing asset. Financing options: bridge, construction, mezzanine, preferred equity, joint venture equity. And for today's session, we're pretty much going to talk about bridge, construction, and permanent financing. Capital sources: agencies, Fannie Mae, Freddie Mac, we do HUD, life companies, credit unions, debt funds, and more. Private money, semi-private money. We have a host of financing options, customized financing for your particular situation. In terms of our loan programs, we pretty much cover the gamut, whether you're doing a $5 million deal or a $500 million deal. We're there for you wherever you are on your road to success from that standpoint. All right. That's about us. So let's get into financing 101. Quick disclaimer. It's not a disclaimer. It's just a reminder for myself, though. Um, since there are so many different financing buckets, we're going to look at it from a general perspective, but just know that depending on where you are and what finance bucket you end up in, things can be tweaked a little bit differently from that aspect of it. A couple of terminologies: debt service. Debt service covers ratios. Basically, your NOI divided by your annual debt service. Typically, your rate of 1.25 is common. However, that's not fixed, and it may change depending on the market or the asset type or the lender. Debt yield, NOI divided by your loan amount. It's a more common metric in your CMBS world. LTV, loan to value. LTC, loan to cost. They are not the same thing, but they can be. For example, if you're buying a property, it costs $2 million and it appraises out $2 million, then your loan to value and your loan to cost are the same. However, if you're smart and you're able to get a deal for 1.5 and it costs $2 million, then from that perspective, your loan to cost would be based off 1.5 million versus $2 million. And another thing, if you're doing a construction or bridge type deal, a lot of times the lender will say, hey, I will do 80% of your costs, not to exceed 75% of your value. So you just want to know what that is in the transaction. Types of debt, basically two buckets: recourse, non-recourse. Recourse, you're responsible for the debt. If whatever happens in the deal. Non-recourse, you're not, assuming you don't violate the carve-outs. Carve-outs are basically specific items identified. Typically, it's just 5 of them: fraud, misrepresentation, gross negligence, environmental, and I think the last one is bankruptcy from that standpoint. In terms of loan amounts, typically with your agency financing, which is more multifamily geared, loan amount starts at $1 million. If you're doing a CMBS deal, it starts at $5 million. And depending on what other type of lender you're dealing with, it may vary from that aspect of it. Typically, when you're looking at recourse and non-recourse deals, your retail banking, your corner store banker, life companies are involved in that aspect of it. Non-recourse guys, agency, life companies, CMBS, and also retail bankers are in that as well, but typically it's not done at your local bank if they do it. Financing options: bridge, interim, hard money, construction, and permanent financing. So What type of loan should I do? Well, it's going to depend on your objectives and the deal. Conventional is more appropriate for a stable asset, high occupancy, high economic occupancy, minimal renovations, if any, from that standpoint. Bridge deals, they're more appropriate if you have challenges, properties need to be repositioned, you got high vacancy, you need extensive renovations from that aspect of it. Construction is typically more ground up. However, uh, adaptive use can fall in that category as well. Also, it depends on how extensive the work needs to be done to the property as well, from that standpoint. Perfect example: have a had a client came in, he bought a multifamily property. It was just after Harvey, and pretty much the bottom floor was demo. It got flooded out. You can literally see from one end of the building to the other end of the building. Only thing left was the exterior walls from that standpoint. And in that particular case, he came in for a bridge loan actually, and we were able to convince the lender to give him a construction loan, which saved him on points and interest rates during the time. So saved him a lot of money for that particular transaction. So I stress the word advisors. Talk to your mortgage broker, tell them what you're trying to do, tell them where you are, and let them guide you through that process. All right, these next two slides, they're more for the permanent asset financing from that standpoint. On the recourse side, you typically top out at 80%. That's more geared toward your multifamily aspect of it. However, you do have some retail bankers that will go up to 80% from that standpoint. Uh, Typically looking at a 5-year term. However, from a retail bank standpoint, some of them will go up to 10. If you're in the life space, they can go up to fully self-amortized depending on the situation. Amortizations are typically going to fall between 20 and 30. However, it's going to be geared more towards the 20 and 25 because your 30-year guys, there's not as many of them, and they're a little bit more picky about what they do. So in most cases, you probably end up with the 20 or 25 from that standpoint. Interest only. Everybody wants interest only. Typically on a stable asset, lender may not be interested in giving you interest only. If they do, it's typically up to 12 months. So it's more like a case by case basis with the lender and with their structure or policy allows from that standpoint. Interest rates typically based off Treasury or Prime or some other indice from that standpoint. Origination fees from the lender perspective is typically up to 1% of the loan amount. Prepayment penalty, it depends on the lender. On the retail side, it typically burns off by the third or fourth year. From that standpoint, if you deal with life companies, it's a little bit different about what they allow in terms of that aspect of a prepayment penalty. All right, on the non-recourse side, multifamily again typically go up to 80%. However, if you're other places like CMBS, you're typically topping out at 75. If you're life codes, they like to be around 65. Remember, these things can vary, but life codes are typically more conservative than other lenders. In terms of terms, it varies 5, 7, 10, up to self-amortizing from that standpoint. Typically, as a standard, your amortization is 30 years, but someone would do 25 from that standpoint. Interest only, it varies, but it can go up to full term IO. So if you have a good deal, you can actually get up to full term IO. It's typically a lower leverage because they're looking at the back end in terms of what the value will be at the end of the loan. They're looking to be in a particular situation in terms of LTV at that point in time. Interest rate, once again, is more treasuries and swaps. Others are used, but it's typically more treasuries and swaps from that standpoint. Origination, typically none of par, but some lenders may charge quarter point, half a point, depending on the situation. Buy down fees, this is more popular with multifamily right now. You can spend up to 2%, get up to about 50 basis points. It varies a little bit depending on what the market is doing from that standpoint. But that's how a lot of people are getting their interest rates down from on the multifamily side of it. Prepayment penalties, typically they're there for the full term of the loan, except for maybe the last three months, particularly in CMBS from that standpoint. Agency, they have different structures. They do a yield maintenance and defeasance, and typically in those cases, it's like the last 3 months that you're open to refinance without penalty. They also offer step downs from that aspect of it. Life companies, a little bit more negotiable. in certain cases, but they're typically more like yield maintenance guys, but they're a little bit flexible. You can negotiate a little bit more on their aspect. All right, bridge, what to expect. Typically, they top out around 80% loan to cost, and that's typically structured 80% of the purchase price up to 100% of the renovation costs. And this, like I said, this is geared more toward multifamily, but same structure applies when you're dealing with office or retail and things of that nature from that standpoint. Typical terms, 1 to 3 years. Interest rate could be fixed or floating. Majority of the time, it's going to be on the floating side of it, and it's typically off SOFR from that standpoint. Origination fees up to 6%. As I mentioned, that construction, the bridge there that we converted to a construction because my guy came in and said he wanted a bridge, but we ended up getting a construction. You can see from that aspect of it, talk to your mortgage broker because they could probably save you a lot of points in addition to just the interest rate side of it. Exit fee, up to 2%, depending on the lender. Some of them do one in, one out, or 2-1 or 2-2, things of that nature from that standpoint. But there is some flexibility in there, depending on the lender from that aspect of it. Prepayment penalties. Prepayment penalties is a little bit different for a bridge guy, depending on the bridge lender. They may want a particular amount of interest out of the transaction. So let's say you get a deal, you're going to do a 2-year deal with them. They may say, hey, I want 12 months of interest. So if for whatever reason you're able to miraculously turn the deal around in 9 months and you refinance them out, you still owe them 3 months of interest from that standpoint. But if you're able to go beyond that initial time frame, then you're able to do something. And you don't have to pay that prepayment penalty from that aspect of it. Construction, you can get up to 80%. But more than likely in the current environment, you're around 65%. Typically, your high leverage is when the market is really flowing, money is flowing much more freely. For example, prior to like 2008, yes, 2005, 2006, money was freely given and LTVs were much higher. But typically, in a traditional situation, you're typically around 65%, depending on the lender. Some of your regional banks, they will take you up to 80 from that standpoint, but just as a standard, you would say 65 and go from there. Terms can be 1 to 3 years. Can be longer depending on what you're building. If you're building a skyscraper or a super regional mall, that can be extended from that standpoint. Once again, the interest rate is either fixed or floating from that standpoint. And if it's floating, it's typically based off SOFR as well. Origination fee up to 1%. They do offer extension options that can vary up to 2% for each extension. And typical extension options run anywhere from 3 to 12 months from that aspect of it. DSCR loans. This is something Joseph asked me about. I only have one lender that actually does this from that standpoint. It's more common in the single family space. I haven't seen it as much in the multifamily or commercial space, but I do have one lender that actually does it from that standpoint, and he can go as low as 0.8 on a DSCR from that standpoint and up to $2 million. And his deal is actually self-amortizing over the life of the loan. So, but he doesn't do any rehab. So it's out there, but I don't know that many is actually doing it or be beneficial. If you're doing a commercial deal, you probably come out better just doing a bridge deal from that standpoint. All right, this agency constraints. This is more geared toward multifamily and agency debt. For first timers, typically they want the property within a 100-mile radius of your personal residence. They require third-party management from that aspect of it. Typically, loan amount cannot exceed your net worth. That's on the SBL side. Once you cross over to the conventional side, it's a little bit different. There's more flexibility in that aspect of it. If you're looking at other lenders beyond that, for let's say a CMBS lender, a life insurance company, net worth is not as important from that standpoint in terms of giving you a loan amount from that standpoint. Key principle. Just want to mention this as it relates to the third-party management for first timers. If you bring in a key pencil, that's someone that has either the net worth and liquidity or the experience If you bring them in, you can drop off the 100-mile radius distance requirement and the third-party management requirement from that standpoint. But in that particular case, they definitely have to have the management experience from that standpoint. But from an agency multifamily loan standpoint, experience is defined a little bit differently. It's more so that they have the experience of being the guarantor on the loan from that aspect of it. All right. So we've gone through all that. You say, okay, what do I need to present to a lender to get a loan? Well, we're going to go through that. Current personal financial statement with real estate own schedule. And I will say this, depending on the lender, you may need tax returns or not. If you're doing more of a retail banking situation, they're going to want tax returns. If you're doing non-recourse, nobody really cares from that aspect of it. So the tax returns and the PL balance sheet, that's more for retail banking if you have not only your personal tax returns, but also if you have a business from that standpoint. Everybody wants to know about your real estate experience and your career experience from that aspect of it. And if you already have an existing borrower entity, they want your organizational documents from this standpoint. Documentation from the property level. Want to know the purchase price, contract price, or asking price. That's more for acquisitions. Cost basis is if you're going to refinance, and they're basically want to know how much you put into the transaction for the deal itself. One low loan amount and terms you're requesting. That just gives an idea of where your head is as it is just right now. We can more direct you based on that information and say, hey, you're being realistic. Hey, you're being unrealistic in this current market environment from that standpoint. Property address and description, current rent roll, unit mix, P&L for the last 2 years, T12 on a year-to-date monthly basis. That's mostly for multifamily. However, I like to see that on hotels as well, because it allows me the opportunity to see is there any seasonality in the numbers from that standpoint. And we can ask the questions upfront earlier. Hey, we saw a drop down here for the last 3 months. Is that common? They can say, yeah, that's common. That happens every time this time of year, or whatever the case may be from that standpoint. Marketing material, OM brochure, it just gives us a little bit of information about the property so we can get our heads around it a little bit better. List of capital improvements over the last 3 years. If you're buying it, we'd like to know, has the seller been keeping up the property? And if you own it, we'd like to know, have you been keeping up the property from that aspect of it? Property photos, copy of leases. If you're doing renovations or construction, definitely want to know your construction budget, rent projections, particularly as well, your pro forma of the next 3 years. Sometimes we go out to 60 months for that pro forma from that standpoint. And also, what do you think the property is going to be worth after you've done your renovation or after it has been constructed from that standpoint? And that is pretty much it for Commercial Real Estate Financing 101. If you have any questions, please let me know.